Good morning and namaskar. The 55th meeting of the Monetary Policy Committee was held in the backdrop of an early and promising start of the monsoon season. This is of vital significance for the Indian economy. In contrast, the global backdrop remains fragile and highly fluid. The uncertainty around the global economic outlook has somewhat ebbed since the MPC met in April in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth-inflation trade-offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the five major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all three fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through 3Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%, and the marginal standing facility MSF rate and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Its latest numbers are 3.2%, with signs of a broad-based moderation. The near-term and the medium-term outlook now gives us confidence of not only a durable alignment of headline inflation with a target of 4%. You are aware we had earlier projected for this year an average inflation of 4%, as excluded in the last meeting, but also the belief that during the year it is now likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is also expected to remain benign, with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook, therefore, for the year is now being revised downwards from our earlier forecast of 4% to 3.7%. Growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty. Thus, the MPC felt that it is imperative to continue to stimulate domestic private consumption and investment through the policy levers to step up the growth momentum. This changed growth inflation dynamics calls for not only continuing with the policy easing, but also the MPC felt front-loading the rate cuts to support growth. Accordingly, the MPC voted to reduce the repo rate by 50 basis points to 5.5%, as already mentioned. After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth-inflation balance. The fast-changing global economic situation too necessitates continuous monitoring and assessment of the evolving macroeconomic outlook. I will now come to the assessment of growth and inflation. First, growth. The provisional estimates released by the National Statistical Office placed India's real growth in 24-25 last year at 6.5%. During 25-26 so far, domestic economic activity has exhibited resilience. Agriculture sector remains strong with a very good harvest in both the Kharif as well as Rabi cropping seasons. The supply of major food crops is comfortable. The reservoir levels remain healthy. The highest procurement of wheat in the last 4 years provides a comforting stock position. Industrial activity is gaining gradually, even though the pace of recovery is a little uneven. Services sector is expected to maintain momentum. PMI services stood strong, as you are aware, at 58.8 in May 2025, indicating a very robust expansion in activity. On the demand side, private consumption, which is the mainstay of aggregate demand, about 56% of the total GDP, remains healthy with a gradual rise in discretionary spending. Rural demand remains steady while urban demand is improving. Investment activity is reviving as reflected by high frequency indicators that we track. Merchandise exports recorded a strong growth in April 2025. Of course, this could be because of some front loading, but this is after a lackluster performance in the recent past. Non-oil, non-gold imports posted a double-digit growth, reflecting buoyant domestic demand conditions. Services exports continue on a very strong growth trajectory. Both the last month's figures have been quite robust. Going forward, the outlook for agriculture sector and rural demand is expected to receive further impetus by the expected above normal southwest monsoon rainfall. On the other hand, sustained buoyancy in services activity should nurture revival in urban consumption. The healthy balance sheets of banks and corporates, governments the government's continued thrust on capex, elevated capacity utilization, improving business optimism, and easing of financial conditions should help further revive investment activity. Trade policy uncertainty, however, continues to weigh on merchandise exports prospects. The conclusion of the free trade agreement with the United Kingdom and the fast progress that is being made in our negotiations with other countries, on the other hand, should provide a fillip to trade. Spillovers emanating from protracted geopolitical tensions and global trade and weather-related uncertainties pose downside risks to growth. Taking all these factors into consideration, real GDP growth rate for this year 25-26 is projected at 6.5%. We continue with our earlier forecast with Q1 at 6.5, Q2 at 6.7, Q3 at 6.6, and Q4 at 6.3%. The risks are evenly balanced. I will now move to inflation. CPI headline inflation continued its declining trajectory in both March and April. The headline inflation moderated to a nearly 6-year low, in fact 69 months to be precise, to 3.2% in April 2025. This was led mainly by food inflation, which recorded the 6th consecutive monthly decline. Fuel group, which had been earlier witnessing deflationary conditions, there was a reversal of the deflationary conditions, and it has recorded positive inflation prints in the last 2 months of March and April. This is partly because of the hike in LPG prices. Core inflation remained largely steady and contained during March and April, and this is despite the increase in gold prices, which exerted an upward pressure. The outlook for inflation provides towards benign prices across major constituents. The record wheat production and higher production of key pulses in the Rabi crop season should ensure adequate supply of key food items. Going forward, the likely above normal monsoon, along with its early onset, augurs well for Kharif crop prospects. Reflecting this, inflation expectations are showing a moderating trend, and this is more so for the rural households. Most projections point towards continued moderation in prices of key commodities. This includes crude oil, which is of critical significance to us. Notwithstanding these favorable prognoses, we need to remain watchful of weather-related uncertainties and the still evolving tariff-related concerns with their attendant impact on global commodity prices. Taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 25-26 is now projected at 3.7%. As I mentioned earlier, this is a downward revision from our earlier forecast of 4%. We are projecting inflation for Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%. The risks are evenly balanced. I'll now come to the external sector. With a moderation in trade deficit in Q4 24-25, alongside strong services exports and remittance receipts, the current account deficit for last year 24-25 is expected to remain low. We are yet to get the final figures. Furthermore, despite rising geopolitical uncertainties and trade tensions, India's merchandise trade remained robust in April 2025. As imports grew faster than exports, trade deficit, however, widened during the month, which is the month of April. Going forward, net services and remittance receipts are likely to remain in surplus, counterbalancing the rise in trade deficit. The current account deficit for this year, 25-26, is therefore expected to remain well within the sustainable levels. On the financing side, in 24-25, foreign portfolio investment to India dropped sharply to $1.7 billion as foreign portfolio investors booked profits in equities. Net foreign direct investment, FDI, too moderated. I would like to take a moment over here because there has been large and widespread commentary on this moderation of net FDI. Now we look at net FDI primarily because of our concern regarding foreign exchange reserves, where the net becomes important. It's not only the net the inflows but also the outflows, which actually lead to either an accretion or a depletion in the foreign exchange reserves. However, when it comes to investment, then it is the gross FDI which is actually important, and gross FDI last year actually increased quite sharply. 14% is a very robust growth that we had, $81 billion. And so India continues therefore to be an attractive investment destination, despite there being a moderation as we are seeing in net inflows, which is primarily because of rise in repatriation, which is again which is a very good sign of a maturing market where foreign investors can enter and exit smoothly, and at the same time higher gross FDI, which is again a sign of our large industrial and other companies going out and investing. So on the whole, gross FDI is high, which indicates that India continues to be a good and attractive investment destination. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at $691.5 billion. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. We remain confident of meeting our external financing requirements. Now I come to liquidity and financial market conditions. You are all aware that the RBI over the last few months, in fact since January, we have injected a lot of durable liquidity through various means, through OMOs, through the CRR rate cut, through the buy-sell swaps, OMOs, etc. A total of 9.5 lakh crore rupees of durable liquidity has been injected into the banking system since January. As a result thereof, after remaining in deficit since mid-December, liquidity conditions have transitioned to a surplus at the end of March. And this is also evident from the tepid response to the daily VRR auctions, which got a bid coverage ratio of only 0.26 in the recent past, and also from the high STF balances. They are averaging about 2 lakh crore rupees in the last 2 months, that is April and May. Similarly, reflecting the improvement in liquidity conditions, the weighted average call rate, which is the operating target for the monetary policy, this traded at the lower end of the LAF corridor since the last policy. The comfortable liquidity surplus in the banking system has further reinforced transmission of policy repo rate cuts to the short-term rates. However, we are yet to see a perceptible transmission, although there are incipient signs of transmission to the credit market segment, but it is still not perceptible, although we are aware and we need to keep in mind that it does happen with some lag. The Reserve Bank remains committed, as we mentioned earlier, to provide sufficient liquidity to the banking system. To further provide durable liquidity, it has now been decided to reduce the cash reserve ratio, the CRR, by 100 basis points. I repeat, we have decided to reduce the cash reserve ratio by 100 basis points from 4% to 3% of net demand and time liabilities. This will be done in a staggered manner during the course of the year in 4 equal tranches of 25 basis points each, coming into effect from the fortnights beginning September 6, October 4, November 1, and November 29 of this year, which is 2025. The cut in CRR would release primary liquidity of about 2.5 lakh crore rupees to the banking system by the end of November 2025. Besides providing durable liquidity, I would like to emphasize over here and highlight that it will also reduce the cost of funding of the banks, thereby helping and accelerating the monetary policy transmission to the credit market. I would like to reiterate that we will continue to monitor the evolving liquidity and financial market conditions and proactively take further measures as may be necessary for liquidity and for monetary policy transmission. I will now come to financial stability. The system level financial parameters of the scheduled commercial banks continue to be robust. The asset quality parameters, liquidity buffers, and profitability parameters have shown further improvement. The credit deposit ratio for the banking system at the end of December 2024 was at 81.84%. This is broadly similar to what it was a year ago. Similarly, the system level parameters of NBFCs too are sound with comfortable capital position and improved GNPA ratios. The stress witnessed earlier in retail segments like unsecured personal loans and credit card receivables portfolio has abated, while the stress in microfinance segment is still persisting. Banks and NBFCs active in these segments, however, are already recalibrating their business models, strengthening their credit underwriting practices, and stepping up their collection and recovery efforts to avoid any excessive buildup of risks on this front in future. I now come to the end of my statement. On both inflation and growth fronts, the Indian economy is progressing well, and it is broadly on expected lines, and this is despite the huge uncertainty that the global uncertainty that we have. Strong macroeconomic fundamentals and benign inflation outlook provide space to monetary policy to support growth while remaining consistent with the goal of price stability. As global environment remains uncertain, it has become even more important to focus on domestic growth amidst sustained price stability. Accordingly, today's monetary policy actions should be seen as a step towards propelling growth to a higher aspirational trajectory. Here I would also like to highlight that there is no tussle between price stability and growth in the medium and long term. Price stability preserves purchasing power. It imparts certainty to households as well as to businesses in their savings and investment decisions, and it ensures congenial interest rate and financial conditions, all of which foster consumption, investment, and overall activity and therefore growth. Moreover, this is crucial for equitable growth and shared prosperity because its absence is disproportionately burdensome on the poor. I must also add over here that while price stability is a necessary condition, it is of course not sufficient to ensure growth. A supportive policy environment is vital. And this is even more important during periods of high uncertainties such as the current times that we are witnessing. At the Reserve Bank, therefore, while price stability remains the focus of monetary policy, we are not oblivious to putting in place complementary monetary as well as credit policies and regulations that support growth and prosperity. Thank you, Namaskar, and Jai Hind. Economic outlook has somewhat ebbed since the MPC met in April in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth-inflation trade-offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the 5 major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all three fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through three Ds. Demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%. And the marginal standing facility MSF rate and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Its latest numbers are 3.2%, with signs of a broad-based moderation. The near-term and the medium-term outlook now gives us confidence of not only a durable alignment of headline inflation with a target of 4%. You are aware we had earlier projected for this year an average inflation of 4%, as excluded in the last meeting, but also the belief that during the year it is now likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is also expected to remain benign, with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook, therefore, for the year is now being revised downwards from our earlier forecast of 4% to 3.7%. Growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty.
Good morning, viewers. Chances are you were listening to the RBI Governor speak live. This was, of course, RBI's MPC announcements. And something interesting has happened. Yesterday, it was a question. Today, it's going to be the headline, and that is the quantum of the rate cut. Rate cut was expected. The market apparently had factored in 25 basis points worth of a rate cut. But as it turns out, the governor, the RBI, decided that the quantum is going to be 50 basis points. And so we'll just start there. I have two brilliant guests with me. Sonam Srivastava, founder of Right Research. She is, of course, also the CEO. And I'm joined by Professor Amirullah Khan. He is the former research director at the Center for Development Policy and Practice. And currently, he is a member of the Telangana State Public Service Commission. Good morning, Sonam. Good morning, Professor Khan.
Hi. Thank you.
Professor Khan, let me come to you first. Let's just talk about, the elephant in the room. Yesterday, we were having these conversations, of course, amongst colleagues and, of course, with experts as well. And the expectation was that, yes, there's going to be a rate cut. We saw this start in February. This is a third rate cut since then. But the question was mostly around the quantum of the cut. And 50, was that a bit of a surprise for you as well?
It was interesting. There was this assumption, and everybody was right in their minds to think that it will be a gradual rate cut of 25 percentage points. But over the last couple of weeks, all of you in the newsrooms and in newspapers have been talking to us rather articulately about the consumption slowdown. Smartphones not selling, cars not selling, motorcycles not selling, and therefore there was a lurking suspicion that the MPC will do something about this, about ensuring that this plateauing of consumption should not continue beyond a certain time. The second good news that was coming in was that, or the second news that was coming in was that the monsoon and the rainfalls seem to be normal, above normal, and therefore we are expecting some sort of an agriculture recovery. It's already done well. Therefore, there was a need that, or there was a feeling that we will certainly have a sizable expansionist approach and a reduction in interest rates so that this consumption story can be rebuilt. What was obviously surprising was that it was done immediately. It was straight away announced very quietly, calmly by the governor that, look, we are getting down to 5.5. And I think given those two issues, one, rather worrisome slowdown in consumption, and the good news that a rather good rural outlook, both together seem to do make it a very wise and a sound decision at the right time.
Right. Sonam, as Professor Khan said, that instead of doing it in bits and pieces, the RBI decided to do it in one fell swoop. Your first thoughts on the 50 basis point cut?
Definitely, I think it is a very exciting sort of a development. I think we were all expecting a 25 basis point, and I think only a very small percentage of people were expecting them to do it with 50 basis point. But I think it's quite exciting. We're seeing a lot of movement happen in the real estate, autos, and NBFCs and related sectors. I think market initially had a muted reaction to it. But I think now we're seeing a lot of positive movement around this rate cut. I think, like you guys said, the RBI is factoring in, some slowdown in consumption, and they want to boost rural demand. Plus, I think the global uncertainty is playing on their mind, and they sort of want to boost growth in the domestic economy. And I think that is the incentive. So let's see how it pans out. But I think it's quite exciting that we got a 50 basis point, right?
Yeah, talking about markets, specifically, Sonam, of course, Nifty has been stuck in that 1,000 point range, right? It's trying to make up its mind which direction it wants to take. So around, at this point in time, just looking at the markets live, and Nifty is about 140 points up, 24,890. And so, yeah, it's trying to make up its mind. The reaction has not been usually as quick as it generally is. The only index which seems to be doing exceptionally well compared to others is the banking index. It's up 1.1%, more than 600 points. And so, yeah, market reaction, of course, we'll keep monitoring this because this is just minutes ago. And I'm sure there was a lot of, details which the RBI governor, had mentioned in the MPC. So the markets would be, figuring that out, analyzing it. And of course, perhaps that's when we will see some of the big moves that may come. Having said that, Professor Khan, let me come back to you, sir. Talking about, front loading, sure. But looking at, what started in February, of course, a series of cuts now that we're talking about them, the stance of the RBI has also shifted from accommodative to neutral now. And at the same time, RBI is trying to, push as far as the growth is concerned in the manner that it can. And he also referred to the limits of, the policy. So if you can talk about these two things, and then, of course, we will go into some of the other things. I mean, what is the rationale? What is it based on? So on and so forth.
Very interesting, and absolutely the right question to look at now. Given the maturity that we saw in the governor's statement, I was particularly struck by the fact that he did talk about, and very, very plainly and matter of factly, about what is happening to foreign investment, both foreign portfolio investment and foreign direct investment. He spoke so very cleanly about the portfolio investment getting withdrawn, a net drop in FDI, and obviously that's a great matter of concern. Now, does it have much to do with the MPC or with the RBI? Not really, and therefore it was important for him, and it was rather insightful of him to have pointed out to the general policy direction that needs to be corrected or reformed to ensure that that FDI starts coming back again. You see, the big elephant in the room. Talking of elephants in the room, one more that unfortunately we haven't talked about, and well, in a technical, theoretical sense, the RBI is not really concerned with that, but the concern in the room is unemployment. And given the alarming rise, he did allude to it in a manner by saying the dangers of digitalization, the danger of the demographic bulge. He did say that, but though he did not, directly
Go into
refer
details
to
and discuss
unemployment.
the employment numbers. Yes.
Yeah. So with so if you see this demographic bulge, digitalization, the technological upheaval in the industry, and coupled with the fact that the foreign investment is drying up for various external and internal reasons, that is a worrisome issue. And with inflation coming down pretty well, he mentioned it. He said core inflation is down, that food inflation is down, which is good news otherwise. But when you look at the entire uh, spectrum of what he talked about, there is this lurking suspicion that a further fall in inflation will definitely result in a further increase in unemployment. And therefore, it is going to be a very interesting 6 month period to look at. That with a sudden boost in the money supply, with a hope that consumption goes up. And that's why you rightly pointed out the banking sector seems to be doing well, because suddenly they're hoping to start lending. It's been a bad 6 months for them so far. So if they start lending, and that's what their hope is, leveraged on increased consumption, then things are going to work out well. And if we manage to get some FDI movement, then I think this gamble is going to play off very, very wonderfully well. But if it is going to impact exchange rates negatively, and if it is going to further push foreign investment, then, and if this big assumption we are making that the inflation trend is going to be softer and softer, and that the rural economy is going to do better and better, big assumptions, fair assumptions given the indicators now. But if they by any chance do not work out the way we do, then we will have a problem in December.
Yeah. And then, I mean, since the rate cut this time around was 50 basis points, and generally every time a central bank starts, cutting rates, the expectation almost always is that, okay, there's another one around the corner. it's incremental. However, the only reason which will probably give people some hope that that might not be the case, in the next, MPC is perhaps the fact that it's been front loaded already. We're talking about 50 basis points instead of 25. I'll come back to you, Professor Khan. Sonam, quickly back to you. I remember, January this year is when we were talking in January, I think, and that is when we started seeing this big sell-off by foreign investors in Indian markets, right? And that continued. It went on in February. That happened in March as well. April and May. We're not going to talk about June because it's barely a week's gone by. So April and May is when they turned net buyers, but the amounts were minuscule. So between January and March, FPI sold $13.5 billion worth of Indian equities. April and May, about $528 million in April. In May, they bought $2.32 billion worth of equities. Now, looking at where we are, looking at where the Indian economy is currently, the way it is set up, and keeping in mind what's happening in the US market, because, and we'll get into the cut, aspect of it specifically. What do you think? Where is the foreign money going to go now? Is it going to stay parked closer to home, or is it going to, come to India? What's going to happen in the markets?
See, I think, like you said, FIIs have started coming back slowly, and I think the valuations are not that drastically high as we were seeing in, let's say, early Jan. I think the earning numbers that came out, especially in the month of May, they were quite encouraging, right? You were seeing many of the companies, especially in the small and mid cap universe, come up with exceptional earning. And what we're seeing is that FII buying is primarily happening in the small and mid cap segment, right? So I think, I think with the US dollar sort of depreciating, with a lot of uncertainty in the US, plus, there are a lot of positive signs I see in the Indian market. Obviously, we are yet to see emphatic growth in consumption. We're seeing consumer sentiment pick up, we are seeing liquidity pick up, we are seeing some positive signs in the earnings. So I think India should be a interesting destination. And I expect, FIIs could keep on buying into the small and mid cap segment, specifically into, let's say, domestic focused companies, and we could see. I'm not sure if very strong trend, but we could see a good trend in that.
Yeah. Yeah. And also what's interesting is dollar is, and perhaps not as strong in the sense that you can't buy with a dollar what you could 5 years ago, 10 years ago, right? And every time something like that happens with a currency, money tries to find other avenues where it can be invested and perhaps more returns and growth can be generated, right? But having said that, hold that thought, I'll come back to it. At this point in time, Professor Khan, back to you again, sir. Now, the inflation figures were, of course, within the RBI's mandate, what RBI is comfortable with. Now, let's talk a little bit about some of the risks, that might be associated with the 50 basis points cut. 25 is what everybody is expecting, and everybody had rationalized it because it started in February. And since then, people knew that, until everything is exactly where RBI wants it to be, these cuts are going to continue. But when you do a 50 basis points cut, are there any risks involved? And if yes, then what are some of those risks?
So, Milton Friedman kept talking about this all his life. He said that what is not important is how much the cut is or how much the increase is. It is how consistent it is and how gradual it is. And that's the first big risk, that this is, way too high. It's good news. If you calculate it from a consumption growth perspective, it should spur consumption growth. It should bank on and leverage on the optimism that we see. However, it is sudden, it is sporadic, and all the concomitant risks of making policy, jump faster than it ought to, are going to run with that. So the first thing is what you've already said, that the business never factored this in. So we'll all have to go back and recalculate business plans. Banks have to do that. Businesses have to do that. What is it that that industry will now do? Will it now suddenly increase capacity? Already burdened with inventory, should it now should it now hope that that inventory will disappear fast off the shelves? And if it does not, then you're stuck with an even bigger inventory. The second is that the risk of we are banking on one of the most unpredictable uh, indicators, which is monsoon.
Mhm.
Uh, right? Will this monsoon continue? I mean, given the climate change variables now,
Yeah,
nobody is betting on how the rains are going to be in June. Forget July.
yeah.
Uh, so will this play out? If all factors line up well for us, then we are on a good wicket. But if any of those play truant, then
Hmm.
we are going to see serious trouble. So so it's really something that that I must say that it's really built on a lot of careful consideration of all factors. So it's not really a wild number.
Okay.
But it is a high number, and with high numbers, with changes like this, we are taking risk, we are taking calculated risk, and we
Mhm.
really hope that it works out. You see, my other big worry, and the RBI governor talked about it at least thrice, is that growth is not as much as we want it to be. With
Yeah.
6.5 and 6.3 and 6.1, we are way off the target. You know, an economy like us at this point in time should be galloping at 10% real growth. If it's 4% below
Yeah.
that,
That's a
then
dream growth number, Professor Khan. Bunch of
I
things there.
know.
Uh,
Yeah,
yes, I mean, I would definitely like to see the economy grow at 10%,
yeah.
11%. But looking at that you
All
also
factors,
alluded to,
all
the governor
factors.
definitely talked about the global uncertainties, etc. That, I mean, I'll just call it that again, the dream
Yeah.
growth number. But having said that, the growth in consumption, which the RBI governor is talking about, is looking forward to, and we all perhaps are, including industry. Where is that growth going to come from? Because when you look at, salary increment numbers, or when you look at, what's happening in as far as employment is concerned, where is that where is that push for growth going to come from as far as consumption is concerned?
We are only banking on rural consumption right now, and
So
that is dicey.
monsoon.
And that's
So
dicey, yeah. And that's dicey because urban consumption, middle class consumption is tepid. It has plateaued. In fact, it might be trending downwards.
mhm,
And that's a huge risk to take, to just bank on. I mean, yes, the rural consumer is two-thirds of India's consumer, but it is a smaller consumer in terms of dollars. Uh, if it does well, yeah, we are going to have a great time. But if that falters,
mm,
and that's a big if, then we will have trouble. So the consumption story, given exactly what you said, the increments, the quarterly growth figures, the lesser number of new job openings, and mind you, there is another issue. Whenever we
yeah,
talk monetary policy, we have to bring in fiscal policy,
yes,
high rate of taxation. You see, with GST collections going up, that's GST collections going up is good news for the government, for people like us. We have more
mm,
money to spend, but it's
mm,
not great news for the economy. And
right,
and therefore, with all these factors, lowering of incomes, lesser number of jobs, lesser increments, and now there is no incentive, there is no push for the corporate sector to give larger increments because hey, the inflation numbers are down. So all these together, where are we going to get that consumption, sir? That
yeah,
that 150 million people who are spending money, those are the 150 million that are going to continue to spend money. That's an issue. That's a serious issue.
right, right. So back to you. We were talking about differential with the global markets, in particular the US. And now, how do you view the impact of RBI's rate cut on foreign portfolio investors, and as far as the flow of that money is concerned, considering the gap has now narrowed? As far as the differential is concerned, the gap has narrowed. what do you think is the impact of this going to be?
Right. See, I think we are going to see some appreciation on the currency sort of front, and I think Indian bond markets are going to become a little bit attractive. I think, especially in the longer duration
Mhm.
period, right? I think that would lead to some inflow. And with the differentials sort of moderating and dollar depreciating in comparison to the Indian currency and in comparison to the other currencies, I think people are going to look at a risk market like India a little bit more attractively. So I think that would be my analysis of that. I think this not only sort of boosts the or gives a case for boost in growth in the Indian economy, but also makes our fixed income longer term fixed income markets attractive. Plus, I think given that the rates in the US are still high, people are going to anticipate growth coming out of India that could lead to equity inflow. But yes, if there is a case for uncertainty, right, and if there is more global uncertainty, I think US with the high rates is still that safe asset or the safe haven, right? So in times of high uncertainty, we can see people maybe jumping back to the US bond market.
Hmm.
But I think as long as the growth continues in India, equity markets in India could be attractive.
Right, right. Or a tweet by Donald Trump at India time, perhaps 3 o'clock, could change the equation altogether for anybody and everybody, as it has since January this year, since the man took charge. Having said that, Professor Khan, my last question to you, and I will come to you again, Sonam, for your concluding remarks. Are there additional measures that RBI can take to ensure that banks pass on this benefit to consumers? And the reason I ask you that question is because, of course, at the end of the day, we're talking about money in the hands of people. That is actually what is going to spur growth. Now, where is that money going to come from? One way is, of course, rural growth, and that's going to be fueled by good monsoons. But weather may play spoil sport there. So that's one aspect. We've discussed it. Now, the other is there anything else that RBI can do to make sure that banks pass on this, the benefit of the cuts to the end, the guy in the end, at the end of the queue?
Honestly, brutally, frankly, nothing. What the RBI can only signal, and we've seen, this is a brilliant question actually. We've seen over the last so many years that the transmission rate is very slow, if at all it exists. Very often, the direction that the RBI provides is not what you see in the bank in Vijayawada. Because the local bank is not sure of the conditions, is not sure of the investor, is not sure of the business plan, and is very worried about the rising or the threat of the NPA. So yeah, so it's going to be really a larger economic question. It's not a question of the RBI mandate or the RBI giving another nudge or another rule. The RBI has given its outlook. It
Yeah.
has announced its new repo rate. Up to the economy now.
Right, right. Up to the economy, up to the banks now. Sona, my last question, of course, to you is going to be where I would ask you to conclude, the your assessment of how the MPC was, and what do you think about the rate cut, and of course, going forward, talking about good results. Given we are talking about consumption, Professor Khan has expounded to some extent as far as where growth in consumption can come from. What do you think that's going to do to, of course, the industry as far as consumption is concerned, and how will that be reflected in the market? So a bit of crystal ball gazing, if you could, please.
Definitely. See, I think the markets are showing the direction today, right? So if you look at the
Yeah.
major indexes, the real estate index is up 3%, right? I think people are expecting the demand for real estate to really go up because sooner or later people would have money to borrow at a lower rate, right? And
Mm-hmm.
even the developers working on those projects can borrow at a lower rate. So I think we're seeing that reaction. We're seeing reaction in the auto, which has been at a bottom for a while, right?
Yeah,
We're seeing good reaction
yeah,
in the auto segment. I think NBFCs are reacting positively. Even banks are positive, even though in the short term, the transmission would take some time, like you said, and there could be some pressure on net interest margins for a small time. But I think it's a big positive, and we're seeing good reaction across sectors. So I think the market is giving us, I think, a sense on what's coming, right? Uh, and I think even in the capital goods space, you would see that these companies can now borrow at a lower rate. So it could bring in more benefits to the industry across the board. I think, like you said, earnings have been encouraging, not extremely positive because sales growth has been low, but we've seen EPS growth. But I think with the positive signal from earnings and a very healthy rate cut coming, I think it's a positive sign for the Indian economy. And I hope that typically when such big rate cuts come, they come at the last moment or the wrong time. I think this time it is not that case. It has come a little bit earlier than that. So I hope
Mhm.
propagates to the economy and we see good growth rate and a good reaction from the market.
Good reaction. Yeah, market reaction definitely seems to be positive. I'm looking at the various indices and the markets right now. Banking, of course, is doing exceptionally better, 700 points up 1.28%. But thank you, Sonam, for, of course, discussing the MPC with us, and Professor Khan. Both of you took time and spoke with us, and for our viewers, help them understand what this was all about, why this was done, and what this may entail. But on that note, thank you so much for taking the time and talking to us. Thank you.
Thank you.